Palo Alto just released their latest earnings report after the market closed. For the quarter, a beat across the board. Guidance, there were some positive changes there as well, but the problem here is yet again, the stock was priced to perfection despite the huge hit that it took 3 months ago. Remember, 3 months ago the stock crashed because growth was slowing down or was expected to slow down because of a shift in strategy, basically going to a more platformatization type of strategy, which they talk about in today's report as well. Right now, at the time of making this video, the stock is down over 9%. Now, meaning this company right now is worth a little bit less than $100 billion, but clearly this is not a cheap stock. We've talked about Palo Alto actually a week or so ago. Since then, the stock has run up a little bit. We were over $320 before they reported earnings, but forward PE, EV to EBITDA, price to sales, price to free cash flow, that's in the last 12 months, it's clearly not a cheap stock, especially not deserving of such a high premium when you look at the numbers reported. That's not to say that this is not an incredible company, a very, very dominant company in the security, in the cybersecurity space. No, it's an amazing company, but again, there is a right price to pay for this stock. And you can clearly see that this company, this stock specifically, has done quite well in the last 5 years. I mean, it's up 330% in the last 5 years. Revenues are up, it's profitable, generating adjusted free cash flow. So that's all great. If you even look at the analyst estimates for the coming fiscal years, fiscal year 2024, sales growth of around 16% year over year, EPS growth of around 24.4% year over year, so an acceleration in profitability. Next year, growth rates decelerate a little bit, but then should reaccelerate or expected to accelerate yet again in fiscal year 2026, 17.24% year over year growth in sales and 18.35% growth year over year for EPS. Now, previously, someone commented on the fact that shareholders get diluted quite a lot with this company, and it's true, shares outstanding throughout the years have gone up, but free cash flow per share has gone up quite significantly as well. And so the more free cash flow they generate, the more cash they'll accumulate, the more shares they will eventually be buying back in the future. Right now, still not buying back shares. And so before jumping into this report, if you enjoyed this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. Want to support me even further, do check out the link down in the description and the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start with a couple of comments here. So we are pleased with the enthusiastic response to platformatization from our customers in Q3. Platformatization is a long-term strategy that addresses the increasing sophistication and volume of threats and the needs of AI-infused security outcomes. We have remained disciplined in our execution while investing in go-to-market and innovation. We delivered consistent profitable growth yet again in Q3 and look forward to executing against our strategic goals and financial targets as we close out the year. It's basically their fiscal year. So first up here, we measure our success in landing platforms over the last several years. So at least one platform, top 5,000 customers for this quarter, 100% landed. At least two platforms at 51%, three platforms just 13%, so they can definitely improve on that metric. Platforms are network security, cloud security, and security operations. If we look at the platformatization aspect, so the progress towards their $15 billion next-gen security ARR forecast in fiscal year 2030. So first up, we have here at least one platform, so that's around 65 new platformatizations in Q3. That's up 40% since Q2. Now, by the way, platformatization is defined as count of all platformized platforms, meaning one customer on all three platforms will count as three platformatization. Then I would assume that the overall here 900 platformatization through Q3 is of those at least two platforms and upwards. So that's 2,500 to 3,500 platformatizations to reach $15 billion NGS ARR target in fiscal year 2030. Again, still some way to go, but that's quite a start. And so what's the big deal with regards to platformization? So IDC here says the point product cybersecurity tool approach is ineffective given the new reality. So one, you have higher productivity. It's 10% lower annualized security related platform cost, but 34% more efficient security teams. You also have better security effectiveness, so 1.4 times faster detection of security events and 1.6 times faster remediation of security events. Which makes sense because everything is on the same platform, can talk to each other faster instead of having different products from different companies. And so with regards to the deal makings in Q3, you had 397 accounts over $1 million, that's up 22% year over year, 84 accounts over $5 million, that's up 17% year over year, and then 32 accounts over $10 million, that's up 28% year over year. And so for this quarter, total billings increased just 3% year over year to $2.33 billion. Total revenue increased 15% year over year to $1.98 billion. Again, met guidance overall on all of those metrics here. Earnings per share non-GAAP at $1.32, beat the guidance. EPS GAAP at 79 cents and adjusted free cash flow, that's non-GAAP metric, $492 million. Now RPO, remaining performance obligations, which is right here, is at $11.3 billion. That's up 23% year over year, growing faster than revenue, which they talk about right here. There is an uptick quarter over quarter with regards to RPO, which of course gives you a better indication of what's to come. Then with regards to guidance for Q4 and for the full year, so total billings for Q4 is expected to grow 9 to 10% year over year. Total revenue 10 to 11% year over year to $2.15 to $2.17 billion. EPS non-GAAP decreased 3 to 1% year over year to $1.41 at the midpoint. With regards to fiscal year 2024, total billings to grow 10 to 11% year over year. NGS or Next Gen Security ARR to grow between 37 and 38% year over year. Total revenue increasing 16% year over year. Operating margin on a non-GAAP basis to be between 26.8% and 27%. EPS non-GAAP $5.56 to $5.58. And then adjusted free cash flow margin of between 38.5 and 39%. Now, if you want, we can compare fiscal year 24 guidance this quarter and last quarter. So total billings, the lower end here has increased a little bit, but the higher end has decreased a little bit. With regards to Next Gen Security ARR, lower end and higher end has increased. Total revenue for the full year has increased as well. Operating margin remains a bit of the same. It's now 26.8% at the lower end compared to 26.5%. EPS non-GAAP did increase lower and higher end, and adjusted free cash flow margin did increase the lower end 0.5%. And so looking at the graph right now, of course, last quarter, a huge drop under the 200-day moving average, did rebound on that day. But then at the end of March, beginning of April, we did spend 2 weeks under the 200-day moving average. Since then, we've had a solid rebound. Now we do sit just above that 50-day moving average at $296. The 20-day one sits at $302 and the 200-day one sits at $278. RSI is high, but nowhere near being overbought. And so what you're getting here is basically a stock that has run up ahead of its results. The market sees the results, are like, okay, a beat for this quarter, but since the stock has run up so much recently, we don't really see these results as excellent, does not deserve a much higher premium, and so we're taking that stock back down a little bit. That's completely normal. We've seen that in the past as well. For long-term investors, what you want to see is the business improving, becoming more profitable and seeing growth reaccelerate. Then the rest will be dealt with, the rest meaning the stock price will be dealt with in due time. Remember, this is a company that is growing in an industry that is going to be very much needed. It's an excellent company, a big company, dominant company in their industry as well. The more profitable it will become, the better it will be for long-term investors. But again, there is a correct price to pay for each stock. The market right now thinks it was trading at a premium. The numbers did not defend the premium, and so you're getting hit by around 10% or so. Big deal. You're back to prices that have not been seen since what? Beginning of May, mid-May, so not that long ago. That will be it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Of course, do share your thoughts down in the comment section below, and I see you all in the next one. Bye-bye.